Happy Friday, Eric Bible with the Bible team at Neo Home Loans. Fed week and a rough week at that. Unfortunately, 30-year fix did not like the comments from Jerome Powell and in turn have moved off last week's lows. This morning, as this message is coming forth, 30-year fixed is sitting right around 7.33%. And yes, it's not the news that we wanted. And there we have to ultimately understand the why behind this move and what it means going forward. So first and foremost, Fed met Wednesday or Tuesday and Wednesday. Jerome Powell took the podium on Wednesday and delivered the news projections forward. As we called, as markets expected, rates at the federal level remained at their current levels, unchanged. At first, as that decision was released, markets responded positively. And there it showed, hey, rates could theoretically get better based on the Fed doing as everyone anticipated. However, once the dot plot was released, and I'll explain what that is here shortly, and Jerome Powell took the podium, the narrative shifted, and in turn, rates pulled back. And I'll explain why. So first, the dot plot. Every voting member gets together at any symposium, any meeting, and will provide their projections on where they see the Fed funds rate being in near term. The dot plot is just that. It does not have names associated to it, but it's just projections. And what caught the markets off guard is that in previous dot plot releases, we showed that the Fed funds rate was going to come down as early as first quarter of 2024. Well, that changed, and it left the door open for yet again another rate hike later this year, but also for rates to remain at their current levels really through 2024, which really, yes, where it provided some clarity and much needed clarity for the markets, it was not the clarity we were looking for. And really the markets were anticipating that, hey, we're at the end of the cycle, inflation is coming down, labor's starting to show signs of weakness. When can we see lower rates? Well, that narrative was ultimately flipped on its head. And really the prevailing narrative out of this Fed meeting was higher for longer. Again, not the message I want to be delivering here, but we need to understand the implications and what happens going forward. So there were some very key takeaways in Wednesday's meeting, specifically around labor. As we know, inflation has been the narrative, and that narrative has absolutely shifted into a robust labor market, given the fact that we have just recently seen unemployment start to rise. Jerome Powell made mention of that. And here, we're going forward, they will either maintain rates at their current level or be open to increasing rates if labor does not show signs of additional weakness. He specifically mentioned the most recent labor report. If we continue to see reports like that, unemployment going up, job creations going down, that is in line with what they are looking to achieve. Maximum employment, price stability. That can only be achieved with bringing inflation down and creating some disruption within the labor market. So, where, yes, it's not ideal, they were very clear in saying if we continue to see unemployment rise, the conversation around rate hikes become more real. And in regards to rate hikes, in the previous 6 press releases from the Fed, podium stands from Jerome Powell, rate cuts were not mentioned. This was the first time rate cuts were addressed. Now, albeit there was no timeline given to when we would see lower rates. There were multiple talking points around what would trigger rate cuts. And that would be specifically, he said, you will know when we need rate cuts, meaning the economy is clearly in a restrictive stance. So again, obviously not the news I wanted to share this week, not the narrative we were all hoping for, but it is the reality of the situation. And here where we've seen for really the last year, a level of uncertainty in the markets, which created massive volatility in rates, we have a little more understanding. I'd say not a little more. We have more understanding of what's actually taking place. We have clear objectives from the Fed. We want inflation down. We know inflation is coming down. We need to see the labor market pull back, not be as strong. We're starting to see that. So as these things converge and we continue to see this pace move forward, we will see lower rates on the other side. That being said, I always want to end on a bright note. And the bright note here is real estate is a quintessential component of the American landscape. The real estate market will never go away. And the reality behind that is people need a place to live. There's no denying that. And with that said, despite rates being where they are, transactions are still taking place. It's our job to deliver and show the value in real estate in this current context to both our buyers and sellers. If you need help conveying this message, my team and I are here to support you. Please reach out. With that, make it a fantastic Friday and an even greater weekend. And as always, we're here to support you.